adding Fibonacci to your trading. Now, tonight's class is also being recorded, and you'll be able to see the recorded version on the Xcentral YouTube channel in a couple days. Now, Fibonacci, before we go into Fibonacci retracements, we have to understand where Fibonacci's came from. Because Fibonacci has really, or had really little to do, or had nothing to do with economics, had nothing to do with the financial market, and it's been around for hundreds and hundreds of years. In fact, we can backdate the use of Fibonacci levels and Fibonacci ratios all the way back to the Greeks. We can find it in how the universe is designed and how the Milky Way goes. We can find Fibonacci levels or Fibonacci ratios in the sculpture of a snail's shell. It's been around for a long time. Now, when we talk about Fibonacci retracements, we're actually talking about retracements of an asset at a 61.8 level, a 38.2% level, and it goes on to 71.6 to 100% of 0. And also we talk about a 50% retracement. We'll get in more details in that a little bit. But 50% actually comes, 50% retracement comes from Dow theory. It's actually got nothing at all to do with Fibonacci. But a 50% retracement has become such a popular tool and such a popular, successful idea that was developed by Charles Dow. It's incorporated in our Fibonacci retracement tool. Now, where does this all come from? Now, you have to understand the basics before you can go on to the most, because you can't even understand why this works or where these numbers come from unless you understand the background. So we're going to talk really briefly about the Fibonacci sequence and then how that's converted to ratios and then how those ratios fit the financial markets. And once you have a basic understanding of the concept, then we can go talk about how to add them onto your trading and put them on your charts. But these numbers come from an Italian mathematician from the 11th century. And I remember somewhere in my, now I have my master's degree in taxation and finance. I have my BS in mathematics, okay? But it's from a long time ago. But somewhere I remember from way back when that some professor told us in a lecture that these Fibonacci levels, Fibonacci sequence was developed from watching rabbits multiply. You know, just like we say Newton developed gravity and the theory of gravity by watching an apple or getting hit on the head with an apple. Somewhere somebody had to come up with the idea. Now, hypothetically, if you were a farmer and you had no rabbits, you had 0. You brought home 1 rabbit, you still had 0 before, you have 1 now. So if you add the 1 to what the 0 was, you still have 1. But if you add 1 more to it, what do you get? You get 2. So 0, 1, and 2 are Fibonacci numbers. And the Fibonacci sequence always starts at 0. So if you start with 0, add 1 to it, add the 0 with the 1, you get 1. But then if you add the 1 plus the 1, you get 2. You add that 1 plus the 2 and you get 3. Add the 2 plus the 3 and you get 5. Add the 5 plus the 3 plus the 5, you get 8. So on and so forth, all the way out into infinity. Now, it always starts with 0, and all of the Fibonacci numbers are always exactly the same. There's no way to calculate them. I mean, there's a big long sequence that we can find somewhere. So if somebody said to you is 9,994,462 a Fibonacci number, we could look at some chart and figure it out, or a computer could tell you that it is. But there isn't really a mathematical number. There probably is a mathematical sequence that will tell you if something is a Fibonacci. But they never, ever change. But it doesn't matter. We don't need to go past about 34. So if you remember, it's 0. You don't have to memorize it. You can actually figure it out whenever you want. 0, 1, 1, 2, 3, 5, 8, 13, 21, 34, 55. That's the only ones that bother us. But those are sequences. Those are just numbers. So how do we then change this into some type of a ratio that we can use in anything to come up with some mathematical properties? Well, I'm going to try to break it down easy for you. Okay, it's not very complicated, and this long equation is actually simplified into what I'm going to tell you now. So, as we said, we have 1 plus 1 equals 2, 2 plus 3 equals 5, okay, giving us the sums of all the numbers in the Fibonacci sequence. Now, if we were to take any pair of numbers in that sequence that are in order, so let's take right now the 21 and the 13, because we got 21 by adding 8 plus 13, and we got the 13 by adding the 5 plus the 8, because we just built it up in the sequence. So now we have 8 plus 13, it gives us 21. So let's take these two numbers that are next to each other. Okay. And if we were to take the 21 and divide it by 13, take this number and divide it by its previous number, okay, that would give us 1.615. If we would go farther out, it's always giving us a 1.61, a 1.618. So the approximation is at 1.618. Now this is beyond the 100% of the Fibonacci. This is called a Fibonacci extension, because when price climbs or declines, okay, you can set your target of where it should reach by using the 1.6018. Now, if we were to go back one step, and instead of dividing the 21 by the 13, and do it just the opposite, take this number here, and divide it by the next number in the sequence. So in this case, we're going to use the 21 and 13. It's always going to give us approximately 0.619618918. Okay, we were to go up one step farther and divide the next step, which would be the 21 and 34, it would give us 0.6176 or 0.618. The next degree up, 34 and 55, would give us 0.618. So this gives us 0.618, which is a crucial number in the Fibonacci sequence, in the Fibonacci ratio, as well as a important ratio in the Fibonacci retracements. So we have 1.618, 6018, and then if we were to go back and we were to go two steps, let me clean up some of these markings for you. Okay, and we were to go two steps. So instead of taking 13 and divide it by 21, we would take the 13, and the 13 plus the 21 would give us what? 34. So if we were to take the 13 and divide it by 34, so in other words, now we're jumping 2 degrees. That would give us 0.382. Okay. Go to the next number, 21 and 55, it would give us 0.3818, which is the same as 3.382. So this gives us our 0.382, which is another ratio in the Fibonacci ratio and another level on the Fibonacci retracement tool. If we were to take that, say the 5, and now move 3 digits, 1, 2, 3, and divide the 5 by the 21, we would get 0.236. And this is our next level in the Fibonacci ratio. Now these ratios, again, were not developed for finance. They're just new mathematical equations. Now it's said that beauty of a person and the attraction to a person can be broken down into these Fibonacci ratios. it's the proportion between the eyes, the ears, the nose, the mouth, the height of the forehead, and the length of the chin. And if the closer they fit to these ratios, the more attractive we find a human being. It's just something subtle. Now, the first number we talked about, the 0.618, is also referred to as the golden ratio or the golden mean, and sometimes called phi. And it's the inverse of the 1.61 is the 0.618. These ratios can be found throughout nature, architecture, and literature. Here you see the spiral of the galaxy. And guess what? These are all Fibonacci sequences. The proportion of 0.618 to 1 is a mathematical basis for the shape of playing cards, for the Parthenon in Greece, for sunflowers, and for snail shells, Greek vases, and the spiral galaxies of outer space. These sequences and these ratios are found everywhere that you apply math. Now, if we were to take the three primary numbers. Now, remember I told you earlier, 50% is a retracement level that came from Dow theory. Now, what we're talking about here is that the basis of Fibonacci and the basis of understanding trends and price movement is that when an asset is moving up or down, it will tend to retrace a certain portion of its previous move. And that retracement of that previous move will either be 38.2%, it could be a retracement to 50%, or a retracement of that previous move by 61.8%. Now, you do have 100% down here and a 0% here, and your 161.8 would be up here because that asset is said that it will move up to this level. Okay. The deepest, now you have retracements that go all the way to 78.6, but these three retracement levels in finance are the ones that are critically important. So what it said is traders use these levels because of the tendency of an asset to reverse after retracing half of the previous move, 38.2% of the previous move, or 61.8 of the previous move. So these same numbers that the Greeks used for the Parthenon are also the same numbers that we use in finance. Now, it said after an asset makes a move to the upside, it can then retrace a part of that move before moving on again in a desired direction. These retracements or pullbacks are what you as a swing trader want to watch when you're initiating long and short positions. They also give us a level of support and resistance. Now, we all know what support and resistance are. There are places historically where prices have hemmed and hawed before continuing to move up or before falling. And when an asset goes all the way up through a resistance level, when it's easing back down, it will tend to flip that and become a support level, and what tends to flip down to that level. There's no saying you can't go right through it, but most of the time it will come down to that level, bounce off it, and then go through it. So in order to find these Fibonacci retracement levels, you have to find the most recent significant swing high and swing low. Now, I'm going to show you this on a live chart in a second. But this is the critically important part that makes you a better trader or better analyst or find a better point than the guy sitting next to you. Because you didn't hear me say you have to find the most recent swing high or swing low. You didn't hear me say you have to find the ultimate top of the trend and the bottom of the trend. I used a little definer word in there, significant swing high and swing low. So by using the Fibonacci retracement tool and using your own personality, your own trading style, because you don't want to jig and jag it. You want to have your own way of seeing. Like I don't think about it. When I'm ready to put my Fibonacci tool on my chart, my brain automatically starts it at one point, ends it at another point, because my eye sees what I consider the significant high and the significant low. And because it varies all the time, I can't explain it to you. Now, you have rule-based traders who want to say that the swing low is the lowest point that it touched in that trend, and the swing high is the highest point it touched in that move. Okay. You want to be that way, you won't be any different than the guy sitting next to you. Now, for downtrends, we take the swing high and pull down to the swing low with the tool. And for uptrends, we do the opposite. We click on the swing low and drag the cursor to the most recent swing high. So let's go over and take a look on some live charts. Okay, I got a couple set up for us here. Let's find if I have one real easy one that we can look at here. Here we go. So here we've defined this movement, and you can, it doesn't have to be a long-term trend. It doesn't have to be a short-term trend. You can define the price movement. So here we decided this was a movement. This was a very short-term trend right there. Now you can put many different Fibonacci retracements on your chart. A lot of people use overlapping ones to define points. If you have to first decide what type of a trader you're going to be and what time scale you're looking at, what time chart you're using it, but you don't want, oh, did I just mess that up? Yeah, I did. Lovely. Okay. Okay. But you also don't want to try to make your fibs fit you what you want them to be. Okay. So here on this Bitcoin chart, you can see this is where we had our Fibonacci tool on for this run from here to here. Okay. This run was over at some point. Now, we have a new run up from here to here. Okay. And so we would put a new tool on. Okay. I will show you in a second. Okay. But you could, and a lot of traders do, extend these lines forward and they will overlap your current Fibonacci levels. And that can tell you something strategically important also, because like you see right here, our 0 level here happens to be at our 100% level here. That tells us something about that level that's strategically important, that price level. Okay, we can see here our 23.6 overlaps our 61.8. Even though these were completely independent movements at different times, we can see that this previous Fibonacci retracement tool could be extended forward. And this one was based on price coming from here to here. This one has nothing, this has nothing to do with it, but all of a sudden we find that these levels are overlapping. So that tells us these price levels are very, very important. Now, how do we put this on our charts? Okay. First, we have to define the definition of our current move. Okay, and remember, uptrends, we pull it down. Downtrends, uptrends, we pull it up. Downtrends, we pull it down. Because we want to make sure we have our 100 at the right place, not a 0 and reverse. Because the system, the tool will automatically drop your levels, calculate them for you. So let's go back to here where I messed things up. Now, if we were to say, and you need the previous trend because that trend has had to end, because you can't deal with a continuation trend because you have to have the top and the bottom. So some people would define that's the swing low. I wouldn't here because I have two candles with the exact one with the same close and open right at the reversal point. So I would give this as my strategic low. Here I have two candles forming a very important high, and I would use that as my high. Now, to put these on our charts, we were looking at a downtrend, correct? Where we just marked the high and the low. Okay. So because price ran down, so for a downtrend, we would click on the swing high and drag the cursor to the swing low. So let's do this together. So let me get my marker off here. So we're going to click on our tools. We can come down here and find our Fibonacci retracement tool. See where I've got it highlighted. And whether you're using the advanced charts on Extension or you're using TradingView like I use for class, they're all going to give you somewhere you click on your indicators and you'll find your retracement tool. They work exactly the same. The calculation is the same. They lay out the same. It's just finding where they are on the charts. So we would then take it from this level and pull it down to that level. And now we've got our levels drawn out into the future. Okay, so we can see our 0 level, our 23.6, our 38.2, our 50% retracement level, our 61, our 78, and this is 100%. 100% basically tells you price fell that far, and if it's going to retrace 100% of the prior move, it's going to end up where that prior move was. Now, we can extend them short-term or long-term, and I've got them turned on to extend to the right all the way. That means they will continue going on forever. You don't usually want that many going on, so you can turn them off at some time. But for the short term, I use them. Now, if I were to pull my prices forward, look at, actually, let's go back here for a second. I want to make these lines a little bolder for you. Okay. Now, let's take a look at what price did as it moved from our 0 level to our 23.6 level to our 50% retracement level to our 68.2. Okay. And then up to our, actually, let me do one more thing here for us also. Let's see if it gives it to me easily. Visibility. I'm just going to move the, actually, let's move them to the center. Nope. Okay, so let's move them to the right. Okay, so all I did was move the numeric values to the right side of the chart so that you can see me. So here is our 61.8 retracement level. Here's our 50% retracement level. Here's our 38.2, our 23.6. Now, look at the journey of price after our Fibonacci's were dropped on our chart. We come up here to our 23.6. Now, granted, we didn't get much of a response, but look at that. We got the close of the candle right on the 23.6. Of course, we got the open of the next candle, but we got that low right on the 23.6. We moved up to the 38.2 and we got no response here at all. But then we moved up to the 50% level. Look what happened. Price got frozen at that 50% level. It bounced off that 50% level and came down to the 38.2, moved back up, but broke right through it and came down here to somewhere in between Never Neverland. But then as it moved back up, it got stuck here again on our 38.2, moved to the 50%, retraced, went right through it, but then it supported price above it. And look at where the highest price of the high got in that movement upward, got dead stopped at the 61.8 level. Then it reversed and went into a total decline. And where did it get stuck? Just for a little while at the 50% level. Went right through the 50%, right down through the 38.2 without even breathing, but came down directly to that 23.6 level and got stuck there. You know, remember, whether we're talking about pivot points, whether we're talking about Fibonacci retracements, whether we're talking about support and resistance lines, these are not finite numbers drawn in the sand. Okay? These are areas or zones that help you predict and understand the movement of an asset. Now, if you were to use fibs in your trading, and say you were going to trade in, you saw this bounce off the 61.8, you said, you know what, maybe I'm going to take a sell. Short-term sell. You could have gotten a very profitable trade here, but maybe you would have said, I'm going to see if it breaks 50%, I'll enter a short sell. I would put my take profit point around the 23.6. I'd watch it very closely at the 38.2. I'd put my stop loss at the 61.8. Because you have your stop loss here, you take profit there because you have to calculate your risk reward ratio, and you got everything. And as you're watching, say you entered the trade right here below the 50% level. Okay, now you've got your stop loss down here because you're not going to put it too close. But if price is moving down, you're watching that 38.2 very, very closely. If price doesn't break through it and bounces off, you're going to close your trade most likely, and you would have taken the short-term profit. But you saw that it went right through the 38.2 and kept on going down. So you could have kept your trade. You would have triggered your take profit, your limit law here, and you would have been a very nice trade from here to here. So you would have been able to trade Bitcoin at that point from 34.4 down to 31,805. $2,000 some dollars. Okay. And that was a very clear-cut, easy-to-see picture of the fibs. It wasn't complex. It wasn't difficult. It wasn't made up. This is a live chart. We dropped them on here together. I didn't do anything that you couldn't have done on your own. Now, in another range, this was a year ago. Again, when we look at the action of the fibs and we have these, and we've combined them, we know this 100. Look at how price for the next year was supported by this level here. The farthest it went was to 7. It came up here to 78.6, bounced off of the 138.8, which is an extension level, came down, and it still got supported a year later by the 100% level. Now, here we're looking at the pound Japanese yen. Okay, you can see our fibs. And let's move into the future trading. And once we do them on our charts, what happened here at the 50% level? What happened here? Look at the 100% level. If we extended it forward all the way to here, and it supported that price. So price dropped all the way down here and got supported at the 100% level. Now, you would have had to draw new fibs because now you have a whole trend going in the opposite direction. And you have the end of this downtrend, and you've moved in an uptrend. So you would be then drawing a new fib level, new fib retracement tool on here, taking from here to here, and Now you have another set of fibs, and you could have overlapped these with those, and they would have just held you true all the way. Now, when the price levels, so we've talked about the 100, the 78.6, the 61.8, the 50, the 38.2, and 23.6. Anything beyond 100 is then considered an extension, because this will help us set our target points. Because when price moves above 100, we could then expect it to continue rising to the 123, which is 100 plus the 123.6, or to the 161.8 level, okay? Because those give us extensions. That's if the fibs keep moving, if price keeps moving, what are the next levels after it exceeds and breaks out the previous level from this previous year? Because if you notice here, this is where we set our high and our low for this fib cycle. Okay. Now, this new fib cycle has now exceeded that number, and we would be looking at these for higher prices. Okay, here we've combined our Fibonacci sequence with pattern recognition. We see here a beautiful head and shoulders pattern. Okay, here we've dropped our fib levels. Let me just hold a second. We've dropped our fib levels on here based on this uptrend and helped to use it to predict this downtrend. And we can see how price is predicted to move in our waves. Okay. Push to the 50% level, ease back down to the 23, push back up to the 0 level, fall down to the minus 61.8. Okay, if price moves against the trend. We have our support and resistance levels on our charts. We have our chart patterns, and we combine that with volume, and there you have an entire trading system. Now let's go back to my PowerPoint. So we've drawn them on our charts. I've explained them to you a wee bit, and you can see Fibonacci retracements are not a system. They're not a strategy. They are a tool to be added into your trading. And the important part is to define the strong move, not a trend line, but a strong move up or a strong move down, and then locate the swing high and the swing low of that movement. But that movement has to have ended. So whether it's a downtrend or an uptrend, for a downtrend, you pull it down. For an uptrend, you pull it up. So in order to apply Fibonacci level chart, you'll need to identify the swing high and the swing lows. A swing high is a candlestick with at least two lower highs on both the left and the right of itself. If you want rule-based, there's your rule. A swing low is a candlestick that's at least two higher lows on the left, both on the left and the right of itself. When using Fibonacci tools, the probability of Forex trading success could increase when used with other support and resistance levels, trend lines, and candlestick patterns for spotting entry and stop loss points. So, but keep in mind that these are alert zones. Retracement levels alert traders and investors of potential trend reversals. Resistance areas and support areas. Retracements are based on a prior move. A bounce is expected to retrace a portion of the prior decline, while a correction is expected to retrace a portion of the prior advance. Keep in mind that these retracement levels are not hard reversal points. Instead, they serve as alert zones for a potential reversal. It's also at this point that traders should employ other aspects of technical analysis to identify or confirm a reversal. These may include candlesticks, price patterns, momentum oscillators, or moving averages. So keep in mind, our common retracement 23.6, 38.2, 61.8 with the 50% down number in the center. So from the Fibonacci section, 23.6, 38.2, and 61.8 stem from the ratios found in Fibonacci. Again, 50% is based on Charles Dow. So we can use these to find entry points, exit points, and stop losses, as I showed you on the previous chart. Here you can see how we've defined the stop loss. We'll set our stop loss just a little bit above or below the next or the previous Fibonacci level, depending on whether we're trading a long or short position, whether we're dealing with an uptrend or a downtrend. So once a trader has drawn his Fibonacci levels, they do not move anymore, and the potential stop loss levels are well defined. So they're not a dynamic. They are hard. They're not hard numbers. They're hard levels. So you're easy to find that stop loss and that take profit points. Just place your stop past the next Fibonacci level. Now, if you want to be a little safer, another way to set your stops would to be place them past the recent swing higher, swing low of the next Fibonacci level. And how would you use Fibonacci to enter a trade? The first thing you should know about Fibonacci tool is that it works best when the Forex market is trending. The idea is to go long on a retracement at a Fibonacci support level when the market is trending up, and go short on a retracement when the Fibonacci level when the market is trending downward. You can also use it to find a way to exit your trade, because for every trade we will have to set a limit order to exit the trade. So it's a good idea to place it just before the level you plan to exit a trade. You should practice it yourself. But my advice is to place exit orders a few points earlier than the next crucial Fibonacci level. So try to set an exit at the top never makes any sense. So trying to set your exit exactly where it should be, it's like trying to catch, we actually call it catching a knife. It's virtually impossible. So right before the next Fibonacci level, or actually two Fibonacci levels up or two down. So thanks to the Fibonacci extension, we get the potential levels where price will stop its move, and where even the whole trend can stop and reverse. So as you've seen, the problem is, what do we do? What do we know which of these levels are going to work? We don't. We only have these to give us warnings, to give us risk, to help us understand what the market might do. And because when we're watching a price move, we need to know important levels that we can see whether it's got the momentum to keep going in its direction or it's losing that momentum. Now, sometimes I use a three-part rule. What I'll do is I'll close out part of each one of my trades as we go through an extension level. So by the time we get all the way up to the 1.618, I'm already out of my trade, but I've taken profit at each one of those levels because I break it down into my three parts. Now, another level that we don't talk about much is the 78.6. This is about the steepest retracement you'll get before you can actually say it's a full reversal, because that means price in the previous move had gone from here to here to here to here and ended up at this point. Now we're expecting it to go in a downtrend here. Now we know at our 100% level, that's as far as we can expect it. But there's this level in between 78.6%. Well, it's like a fire sale level. A lot of people are already out of the market because they set their stop losses or their take profit point, and they're long gone. Well, guess what? When price, if you think that price is going to continue its current movement and continue upward, or the signs of it continue that trend, something happened that it's just easing down. Well, the big sale price is 78.6. 78.6 is the last stop along the way. So if you see price stuck at 78.6, it might be a very good point to enter a very, very cheap trade. And a lot of traders will always jump in the market if there's a potential at the 78.6 retracement level. Fibonacci levels give traders an opportunity to join a trend at a discount and ride the continuation of the trend. Have you ever heard of the expression sell the rallies, buy the dips? Fibonacci traders combine both the 88.6 and the 78.6 Fibonacci retracement levels to highlight a hot spot trading zone where high probability trades are more likely to take place. Indeed, the zone between 78.6 and 88.6 Fibonacci trade is hot spot because it's the last point before we actually go into a full reversal. In times of high volatility trading, the price tends to respect the 70. When you're trading in a market that's gotten really highly volatile, when it's getting very volatile, it will tend not to fall all the way down to 100 to the 0 or the 100. It will tend to respect that 78.6. That's like the bottom step. And there you could actually either get in a trade, or if you were in a trade and you're not sure, you think it's just a highly volatile market, but the uptrends continue, that you would move your stop loss to that point because you're saying, I want to stay in this market. Now, Fibonacci retracements are often used to identify the end of a correction or a counter trend bounce. Corrections and counter trend bounces often retrace a portion of a prior move. While the 23.6 retracements do occur, the 38.2 to the 61.8 covers the most possibilities with 50% in the middle. This zone may seem big, but it's just a reversal alert zone. Other technical signals are needed to confirm a reversal. Reversals can be confirmed with candlesticks, momentum indicators,